is dollar depreciation coming? How much can we expect? And just how bad can it get for USD here, as it seems like it's been nothing but bad news for dollar bulls in the last, call it 5 or 6 months, going back to the fall of 2022, looking at the most popular pair in the space. And remember that whenever you're talking about a currency like US dollar, which we're going deep on here today, and its potential to depreciate, that depreciation always comes at the expense of a different currency market. So euro versus dollar, two of the biggest economies in the world, the Eurozone and the US, most commonly traded pair of the last couple of years here. And so that's what we're going to use to paint this picture here to start. And you can see that this euro, since fall of 2022, has bounced back from about 95 cents all the way up to $1.10. That's a 15% move from high to low. And right now we're trading at those highs of $1.10. That's a big move for currencies. In a given year, currencies are only moving 5 to 10%. And in the last half a year of trading, this euro is up 15% from those lows, begging the question of how bad can this get? And if you look at this in a vacuum, and of course we're not going to look at it in a vacuum, I'm about to supply you with a whole bunch of data here, you might say, well, Frank, you just told me in a given year this market only moves 5 to 10%. In the last 6 months, it's moved 15%. Wouldn't that tell me that it's overdone? If you're looking at just the last 6 months, then yeah, maybe this is a little bit more than expected, and it can come back a little bit. You'll see that just 2 months ago, we got up to this 110 level and backed off all the way to 105. In that short term, maybe this is as much depreciation as the dollar can take. But in the long term, a very, very different story. You can see how much room there is to run for this euro against the US dollar to the upside, and vice versa, the US dollar to the downside here, because 110 is an area that we've only spent about 5% of the time below, and really is kind of the lows for the last 2 decades of trading in this pair. And of course, anything can happen next week and beyond, but historically speaking, so much room to cover here. Back in the late aughts, we were at above $1.50, and we're just at $1.10 here. And I know it feels expensive for that euro, but you go back even to 2017, 2018, and this market is at $1.25. I mean, you go back to 2021 before the onslaught of all of this inflation here in the U.S. that caused interest rates to move higher, and saw some appreciation in the U.S. dollar. And we were, before all that, at $1.25, and right now at 110, plenty of room to cover, which begs the question of, is this a blip on the trend lower for big currencies like euro against that US dollar, or is this the start of some mean reversion? If you've watched the show before, you'll know that I'm constantly advocating for different markets that have historically shown mean reversion, like implied volatility in options markets, from everything from stocks to crude oil and what have you, and then on to other mean reverting markets like interest rates, and here today talking about Forex. And if this mean reverting characteristic that's existed for the last couple of decades, I mean, pretty much as far back as I have data for in this Euro USD, I think that we've done studies before going back to the 80s, you've seen these outlier moves up to, here in the Euro, 160, 170, in the British pound, to up to above $2. You've seen these outlier moves as of recent here, down to 95 cents in the euro and down to 105 in the British pound. But historically, these markets have come back to a mean, and the mean in this market for the last 20 years is definitely closer to 120, 130 than it is to 110. And so, yeah, it's been a 15% run here in the euro over the last 6 months, but that's off of historic lows that we haven't seen for more than 20 years. And it could just be the start. Now, you especially bring that idea to a market like yen that relative to euro is even lower in its extremes, given the historic action in the yen to US dollar trade right now, trading at about 0.8 of a penny, actually not even there quite yet. And those are levels that have been the low, not even, we spend 3%, 4%, 5% below that over the last 20 years. But in the last 20 years, they haven't gotten below that. That's been the level that in the mid 2000s, in the mid 2010s, they bounced off of here in Japanese yen, and were able to get back to what's been more of the average, the mean, closer to a penny, and has been as high as almost a penny and a half. And so you look at some of these historical numbers, and I know that we're only a couple of months removed from inflation going through the roof here in the US, interest rate projections getting up to 5-6%, and every media outlet calling for this US dollar bull run to continue, and euro to get down to 90 cents, and the pound to get down below parity. And some of those fears are still there. We still have inflation here in the US of 6% was the last reading. We have a reading next week. In the Eurozone, though, they have inflation of 7, 8, 9%, depending on what country you're looking at. In England, they have inflation that is right on par there. And so for this to turn around and get back down to the lows, especially looking at this euro market, that yen, it's a bit of a different story because they actually haven't been seeing too much inflation. So we'll get to that actually in a second. And that's why you're seeing the greater discount, relatively speaking, to the euro. Yes, those fears are still there. And yes, inflation can go from where it was at 9%, a little less than a year ago, where it is now 6%, and then back to potentially double digits. Absolutely. But it does seem like they've shaken out those extremes below $1 here in euro versus US dollar, and intent on maybe doing some mean reversion. Only time will tell. But don't get stuck in this idea of 15% up move in euro against the dollar. This thing has to revert. We might be doing some long-term mean reversion right now from what are lows in that same market. Now, how did we get here? I think is a good question to ask, because that will help tell us what needs to happen to see further depreciation in this US dollar. The US gained significantly. You look here, this isn't just a chart of interest rates here. This is the chart of interest rate gain that the US has seen relative to these different regions. And as we've gotten up to around 5%, we're just short of that, but we might as well round it to 5%, where the Fed currently is. We've gained a percentage point on the Bank of England. We've gained a little over a percentage point on both Australia and the Eurozone. The reason why we are, trading at such a high premium to the yen is we've gained almost 4.5-5% over this Japanese central bank, because they're still at zero. They're not seeing as much inflation, and so they're not ready to necessarily hike interest rates to calm an inflation that's not occurring, because their economy has been somewhat stuck in a rut the last couple of years. But all of that being said, giving you the reason behind why the US dollar has gone on such a bull run in the last year or so, this stuff can unravel just as quickly as it gets built in, sometimes even quicker, especially if some of these, fears around the banking sector, some geopolitical fears, if those set in quite quickly, you can see the interest rate gains that we've had on these different territories. And remember, as a quick aside, that the reason why interest rate gains correlate to currency appreciation is because if the US has much higher interest rates than Japan, for example, then people will, in theory, be selling their Japanese yen to buy US dollars to invest at the higher interest rates here in the US, in the US treasuries, relative to the equivalent in Japan. But just as easily, like I say, as we have built this in over the last year or so, given and it's been quick because inflation is onset quite quickly. And we went from 0%, where we were with Japan and pretty much everyone else, to 4%, 4.5%, almost 5% now, very quickly. Any of these fears kick in and our interest rates could be taken down to near zero again, just like they were at the onset of the pandemic or the 2008 financial crisis or what have you. And if that occurs, if interest rates across the globe get flattened or the US interest rates get actually lower than they are in England or like they are in the Eurozone, you might see this dollar really depreciate, not only to the long-term averages, but to those lows against euro and pound. And I will just bring up this pound chart because you'll see, similar to that euro, it's been a nice run in British pound from about 105 to 125 here, almost a 20% move from low to high. But there is a lot of ground to cover. Like I said earlier, in 2007, this pair was above $2, and on average, we're trading closer to $1.50 than we are $1. And right now, we're just at $1.25. So, should you go on your vacation abroad now? Maybe. I mean, history will tell you, historical price action in these currencies will definitely tell you that we're closer to the lows in terms of these other currencies, the highs in terms of US dollar. Right now, pound for pound, US dollar is, definitely worth more than it has been, or it's closer to those highs than it is its averages, let alone its lows of how far it can depreciate. And that being said, in the short term, anything can happen. I mean, in any term, anything can happen. Have to always convey that idea. But given this historical price action, you have to imagine that in the longer term, putting time horizons aside, this is looking like some mean reversion, and these are mean reverting markets. And so we'll see if we get back there. How far can the US dollar depreciate from here? Well, it looks like it's only 10 to 20% of what historically it could do. All right, now to close out my last show of the week, give you some of these numbers around non-farm for tomorrow morning. Weird holiday non-farm, but they are going to come out with this data, and you'll likely see futures markets shift around. The forecast is 240K. Last one came in at about 310, and I think that was a little bit over what was expected. And the market mostly shrugged it off. I think you're going to need to see, for the people who are expecting inflation and trading on the side of inflation, you're going to need to see maybe a print of 320, 350 here in non-farm payrolls, and maybe wage growth here we have in front of us of, I don't know, definitely higher than the 6% that we've come down to from the highs of close to 7%. You're going to need to, see those bigger numbers for the inflation fear to kick back in and interest rates to rise again, because they've definitely been trending lower. On the flip side, if we do see a number that's below 200,000 or below 150, something that's real low relative to the last year or so of non-farm numbers, you might see those interest rates really sink further, and that's been pretty good for stocks in recent trading. We'll see what happens. I know I'll be watching, even though we don't have a normal trading day tomorrow. And finally, will the Aussie wake up? Really looked like they were going to take off above 68 cents. And you can see that little blip. That was Monday of this week. Really strong price action, bullish price action here in Aussie versus USD, but gave it all away, gave all of it away and then some. I think they ended up down on the week here, and we're really trapped inside the 66 to 68 range.